Welcome to the Broken Pie Chart Podcast, episode 391. I'm your host, Derek Moore. With me once again, Mike Snyder, Shane Skinner. All right, it's I guess we're recording again on Monday. So weird not to be doing this on Friday. Market had, I don't know, a little bit of a soft opening today. NASDAQ especially. I think, the Qs, if you look at those, closed down 1%, pretty much 1% on the dot. And I don't know, so apparently we're in a trade war with Canada now. And I don't know if we'll touch on that or not. The Strait of Hormuz is closed, or is it? Some reports say that, they're turning the transponders off and it's flowing. I thought it was interesting. Tobias Carlisle put something out on Twitter, and he showed a chart of, let's see what this is. Big oil is printing cash despite manipulated oil price. Okay, this is Lucas Ekume's tweet, and he was just, kind of talking about oil prices. So big oil drills a cash gusher. The top 5 international oil companies generated $70 billion in free cash flow last quarter, surpassing the high set during the Russian invasion of Ukraine. Tobias goes on to say, unlike 2022, this surge isn't obviously driven by a war shock price. Oil prices have been comparatively range-bound recently. That suggests structural improvements, cost discipline, operational efficiency, portfolio high grading, divesting weaker assets, and capital discipline. Majors have been reluctant to overinvest in the new production the way they did in past boom cycles. I'll throw in something else. I think this is there really a supply issue with oil? I mean, that's the common narrative, but if there's not a supply issue and you have a risk premium on top of oil prices that are driving them higher. Remember, they were like under 70 before this started. So now they're up in the 80s again. At one point they were pushing 90, especially Brent. Is this like, if there's no supply issue, and I say no supply issue, I don't mean there's none. I just don't mean it's not, the supply issue is not necessarily commensurate with the rise in oil prices. So between what Tobias said, and he's much smarter than I am on evaluating companies, I mean, look at Exxon. So Shane, I'll come to you first. To me, this is just prices going higher because of perceived issues or the risk premium that's on there. Tobias is saying this, but I mean, to me, this oil should come down if they wrap all this stuff up, but maybe it doesn't. And companies do really well. Oil is tough business though. Sometimes margins are negative, sometimes they're good.
I wonder I don't know where it's at. I thought I saw recently it said strategic reserves are lower, obviously globally, but I think we're at a level we haven't seen since the 80s. And I think you're right in the sense that a risk premium's being attached to sort of like the narrative that's going on right now about where supply sits. Now, the question is this, if supply can be replenished and or there's not a crazy imbalance in the future with the need for oil and gas versus, what we've got going on now, then yeah, I think things settle down. But it's hard to, in this environment, when people are kind of maybe looking for who's gonna lead in the near future, I think that, maybe there's sort of a crowding into energy too. You just saw XLE break an all-time high last week, and it's pulled back slightly today. But, maybe energy is an area that gets hot again. We'll see.
Mike, this was your top pick at the our prediction show, right? This is actually your contrarian pick. You're like, nobody wants this. Now the companies, whether it's Exxon, whether it's XLE, like Shane mentioned, kind of an all-time highs. But like it or not, this is a tax on consumers. Like inflation's a tax on consumers. It costs more to fill up the car. It costs more. Companies in using oil in any regard, it costs more. We see it in airline fares, although, I mean, earnings were pretty good on the airlines. So, Mike, is this a case of, yeah, it's actually not as bad as we think? There's been a bunch of improvements. Or, I mean, yeah, that goes part of it too, capex, because they were talking about free cash flow, and free cash flow that's spent on capex reduces the free cash flow. So, I don't know.
Yeah, I mean, it seems like everyone is paying more for oil, yet it does not cost big oil any more than it did, 6 months ago. So it's just going right to their bottom line, and everything is being trickled down to the consumer or the end purchaser, who's then, increasing their prices on goods. So, it seems like the market oil is, higher than it was back towards the end of last year and earlier this year, almost because, the market's saying, okay, we could see this becoming a bigger supply issue. I think if there was a real supply issue, oil would probably be higher than this. This is sort of a level where it's like, there's a threat that there could be a supply issue if things get worse. That's sort of how I read this chart.
I mean, that's generally thought of bad news for consumers. It's called, higher oil prices. It's bad news for consumers. It's a tax on consumers. It's inflation for consumers and for companies. Despite that, earnings estimates have never been higher. On the economy too, Luke Kawa put out something and he said, look, weakness in long-term government around the world is primarily a good news story. Long-term government, I actually don't know what he means by that. But Citi Global's Economic Surprise Index at 41.6, the highest since April of 2022. And he shows a chart. The Economic Surprise Index, it's not like, oh, it's things are really good or really bad. And I mean, things have to be good for you to have a positive surprise normally. But this just means, like, what do the analysts think? And so if the analyst, let's say there's really, really good economic news and everything, all these bits that go into the index, but it doesn't exceed the analyst. It could be record the best economic data ever. And if it doesn't exceed the analyst expectations, it's not a surprise if it just came in right at target. And the inverse is if data comes in lower than expected. And so, if you look at a chart on this, 2020, late 24, early 25, probably 25 is, probably right around there during the tariff tantrum. A lot of times though, since 25, the Economic Surprise Index, not surprise, it's been higher than expected. 22, we saw that. 23, we saw that. And so it looks like the analysts are a little bit too bearish is what this is telling me. And that doesn't surprise me because they're a mark. I mean, there's a lot of economists. And remember, 29 out of 30 leading economists, I'm smiling in air quotes as I'm saying this, in 2023, going into 2023, said almost 100% probability we have a recession. We did not have a recession. And 23 had some very good economic surprises. So I think that's, they're too bearish. The analysts are too bearish, Shane.
I almost think that I almost think with the statement about weakness in long-term government around the world is primarily a good news story. I think it's maybe him saying, hey, if everybody's, experiencing inflation, if everybody's experiencing shocks to their economy in some aspect, that it's all kind of relative, It only gets really, really bad or really, really weird when it all happens at, in a concentrated place all at once. And then that's when you see an economy really, really suffer.
See, I think he meant government bonds. Maybe he meant the weakness in long-term government bonds.
Too. Yeah.
We'll get to yields, but the point of this is when you look at this chart, it's like, surprise, data's been better than the analysts have expected. Now, gold is definitely catching a bid. We kind of talked about gold and we said, it came down to that 4,000 level. So gold per dollars per ounce, not necessarily the ETF. And, it obviously it ran from 4,000 all the way up just under 5,500, kind of that 5,300 level. comes all the, starts the January high, makes another high, a lower high in February, and then it kind of comes back down, all the way back down to 4,000. Consolidates there, and we're seeing a bid. I mean, would it surprise me to see gold get back to 5,000? No. Would it surprise me to see it go to 3,750? No. But Mike, I mean, this is a little bit of a classic technical pattern where you have a consolidation area, a collection, a little bit of a settling, and seems like it's getting a bid. And I'll just skip ahead to the next thing. The gold ETFs are getting flows, Mike.
Yeah, doesn't surprise me. I mean, the technical pattern sort of lines up well, I think, with a narrative that the Treasury came out and said they were going to double their buybacks in bonds, and I think that is perceived negatively in terms of the strength of the dollar. So I think there may have been a flight to gold. I know you probably don't want to talk about it, but we've seen Bitcoin up since then too.
I don't
by quite a bit. But I think that's worth mentioning.
I mean, this is classic though, the flows. You look at the flows chart, and so this is from Bloomberg, Goldman Sachs, FICC and equities. Is anybody else on this? A lot of people credited here. Good. And posted by Isabel.net. Have I credited everyone? Great. So you've got the performance, the weekly performance, and then you've got the weekly fund flow in billions. And yeah, like, not surprising. When the performance is bad, people are selling it, and the performance is good, people are buying it. And the flows the last, let's say, 3 weeks, all positive. So it seems like people are putting money back into gold. It's, it's not surprising. And I think there is, just talking to investors, talking to advisors out there, I feel like some people who missed it the first time said, well, I don't want to buy really high. I'd rather wait till it comes down a little bit. Now, they never get the bottom. They never get the interim bottom, but they're getting a little bit of a sweep up higher here. So, yeah, I mean, it's not surprising there. Getting a little action on there.
I think maybe, even with some of the momentum trade in the semiconductors sort of slowing off, it did catch a bid there for a bit and back down again. I think, maybe we're seeing some money rotate out of there into other areas.
Out of semis into gold. That's the triangulation.
I mean,
why not?
I'd make the argument you might have saw some gold flow or some flow out of gold and into oil. If you look at when oil really started to take off this year and what gold did around that time and forward, kind of looks like that's where gold topped and started to base sideways down a little bit, and oil started to take off. So maybe at that time too, commodities traders, I don't think they discriminate. If the trade was stalling in gold and it looked like oil was the play, you might have saw some rotation there. And now maybe we're seeing again, like you said, Derek, you're kind of getting a little bit of a bid here in gold and oil starting to pull back. Are you maybe seeing another rotation or dispersion there?
Well, that's possible. Other people said, well, gold is selling off and Bitcoin's going to run, but actually gold and Bitcoin are both catching a bid. So look, I mean, the one thing I'll say about Bitcoin is people are like, oh yeah, no, it's a hedge against inflation. No, it wasn't. It didn't do well in 22 and 23. Or they say, gold is done and Bitcoin's a thing. No, gold went on a run. Or they can't both go up together. No, they're both going up together. So we don't have Bitcoin on the docket this week. But see, you forced me to talk about it a little bit. Good for you, Shane. You got it in there. All right. Let's talk about the upcoming midterm election. So you'll start to see charts like this. I know I've started to. I pulled one from, who is this from? Nautilus, posted by Isabel.net on Twitter, or X, I guess we should call it. The S&P seasonal composite midterm election year. So basically this is, how many years is this? Last 99 years. Okay, that's a long time. And what it says is the seasonal, September tends to be pretty weak. It's ranked 12th out of 12 months. Yeah, you see how they did that? Like the best month was number one. There's 12 months. Okay. So the average is minus 1.48. Up, down, 11 out of 13. Oh, 11 out of 13 up, down. I don't know what that up, down score means, and I don't know what significance is. So maybe there's an article with this. But the typical index, you sort of run into mid-August, and then you come down through the end of September, and then you start to rally again. And, the forward seasonal composite returns from August 20th, 6 months, positive, 3-month positive. So I guess what they're saying is, in a historical seasonal pattern, we're coming into a weak area in the midterm year. But then I think you'll also see those charts, like the 1 year after the midterms, the markets have never been down. I think that's still the case. Who knows this time? Mike, are you shorting the market right now due to this chart?
No, of course not. But okay. It seems so obvious, yet, it's probably not something you act on. It's like, of course, the market doesn't like uncertainty, and I would consider the midterms to be something that creates uncertainty. So the market sells off with worry, and then the midterms happen, and regardless of how they shake out, it's over. Market's just happy it's over, and some outlier didn't occur, and it goes back up. It seems obvious.
Notice, Mike, though, look at the black line. That's the 99 years historical index. Mm-hmm. The high is usually in April, and then it drifts down, a couple lower highs. It's the opposite this year. Like our low was March, and we're just recently at the all-time high. So this is a different pattern. So, this is like a composite of all the years. Doesn't mean all the years are like this. But right. Don't you think it's interesting? Like, this year is different than
yeah.
It's flipped a little bit. So now you're buying. You're all in for September, right?
You've convinced me. It's got to be the opposite.
See, this is hard stuff. This is why we buy and we hedge. Okay, so let me talk a little about change in term premium. All right, what the heck is that? It means the longer maturity bonds. What is the extra basis points, or what's the additional yield that someone is getting in buying a long-term bond as opposed to a short-term bond? And this is a chart from, Augur Infinity. And they're comparing the US, UK, Germany, and Japan. And basically what they're showing in this chart is index to Kevin Warsh, Fed Chair, first FOMC. Okay, so this is from his first FOMC. What is that, like May 3rd? Sometime in May. So, oh, no. His first one was June 14th. I got it. That's the dotted line. Okay. They could have labeled that for me. But maybe I just should have remembered that was the exact first meeting. So what you look at is the U.S. has a higher, the change in term premium in the U.S. has been higher, meaning longer dated maturities are rising more relative to near-term maturities. And then you kind of look at UK, Germany, and Japan, and the term premium is sort of rising less. And I think in the person who put this on Twitter, I lost it now, but it was their idea, not mine. So they're kind of saying that the term premium is a US-centric thing. It's not really happening in the other countries. In the other countries, their yields are higher based upon inflation. Ours are higher because of the change in the term premium, not necessarily inflation. I went back and I looked and I said, where is this here? Where's I think it's the very last thing. Oh, no, different thing. Okay. So, I kind of looked and I was like, there are times when people say, well, bonds are going up because of inflation. Other times people are saying, well, bonds are going up because of inflation or the debt level. And that's the problem. Oh, this debt list is too crazy. If you guys look at the second to last chart I put in there, that is a chart going back. Let me see how many years that goes back. This is from Bloomberg. I generated this since 2013. Chart of the debt GP, and the measure there is Oh no, this is housing. Totally forget that. Debt to GDP though is higher than it's been. Maybe I just didn't send this to you guys. Oh, you know what? I put it in our message. Hang on. There we go. Okay, so you look at this, the debt to GDP, and you would say, all right, 1981, it was around what, 40%? And this is federal debt, total public debt as a percentage of GDP. 81, 10-year treasury was like, almost 16%, just under 16%. And then you look and you say, well, the highest debt to GDP ever recorded was in 2020. That was just under 130%. And what was the 10-year treasury? 10-year treasury was under 2%. So now, debt to GDP is still high. Look, I'm not saying there's not a lot of debt, but it's not making a new high, but the U.S. 10-year treasury is rising. It's the highest level it's been going back to, 07, 08. I would argue that normalizing yields and a healthy yield curve is okay. But Shane, I go back at this, like the reason when you see this, the media always has to have a reason. There's some reason in the media that they choose that is the reason du jour. But if you look at this, you would say, well, actually, yields can go up when debt to GDP was lower. But there also could be a growth story here. And over the long term, nominal GDP growth and the 10-year yield over, let's say, 10-year periods, there's some correlation there. So Shane, is this a growth story? Or is this, debt to GDP, markets can't absorb this much treasuries in the market, or inflation, the whole bit. And look, I'll let you know when I know. I'm just saying.
Look, I don't think it's a combination of things. None of these things are ever one answer, right? But I think that this isn't just a U.S. isolated thing. I think the U.S. is impacted differently, but I think we're witnessing a global duration repricing because it's also happening in other countries. Yields are going up there too. So it's not like the U.S. is the only one with the back end going up. Anchoring this chart to since Fed Chair Warsh took over, I think is also giving the implication that maybe the market, since he's come in, is a little more uncertain about what's to come with some of the, I guess he's just been less colorful than prior Fed chairs have at these meetings. And so maybe the market's a little uncertain about what's to come from the Fed. And then I think simultaneously too, I think there's a real demand, not just in the US, but across the globe, with governments running deficits, very large deficits, having to print large amounts of money. People just want more yield in return for having their money locked up for that much longer. It's not necessarily just I think a negative on the U.S. or a bad thing. Again, you're seeing it happen everywhere. So I just think it's durations being repriced across the globe.
Mike, you hear certain people on CNBC, they'll come on, they'll say at some point, yields get high enough that they displace the need or the want to own stocks. Like to me, if the 10-year got to 6%, maybe 7%, 7% especially, you kind of got to ask I can hold this for the next 10 years and get 7% a year, or I could own stocks and have the risk. I don't know. Is there a level, Mike, you think is a problem? A lot of people said, well, if it gets to 4, that's a problem. If it gets to 4.5, it's a problem. If it gets to 5, it's a problem. And the markets kept going up.
Yeah, I think it depends on the investor and where they are in their, investing cycle.
Right, that's a very PC compliant answer. I like that, Mike. Good job.
Well, for real,
obviously we don't give we have no idea who's listening. Yeah.
Someone who's 25 shouldn't own a treasury, probably won't own a treasury even if it's yielding 7%. Right. Or 8%.
Many years they don't need the money.
Yeah. Right. Agreed. So but market wide, is there a problem? Yeah, I think eventually it becomes a problem where, rates for something that's perceived as so safe become so attractive that why would you take the risk in the market? I think there's certainly a level. I don't know that we're really anywhere near that when you look at earnings and projections for the market and how the market's returned over the past few years. I don't think we're anywhere close to that, but certainly there is a level.
I look back at the 90s, and the 90s had fairly high rates, higher Fed funds rates than we had now. 90s was a very good decade for stocks, very good decade. So, I don't know if that's I think everyone's vision of this and their memory clouds their long-term appreciation of where rates are right now. I mean, we had near zero rates for a decade. Our rates today are not high. Go back to the 90s, go back to the 80s, the 70s, obviously, the 60s. Rates are not high. They're really not. Early 2000s, these rates are not high. We just talked about the rates are, this is the highest we've seen since 2007. I mean, it's not high. So, all right, Liz Ann Saunders brought up, we have GDP, the second revision estimate is coming up this week. She said, look, AI capex boom equals GDP growth tailwind with a question mark. And what she says is the math. Massive corporate spending on semiconductors infrastructure is driving imports. Asian chip manufacturing, U.S. exports benefits remain muted. Result, question mark, GDP's import-export equation shows a drag despite investment boom. So, and then, she shows a great chart. This is from Charles Schwab. GDP components, the percent of GDP. So consumer spending makes up about 69.3% of GDP. So that's the biggest driver. Government spending is about 16.4%. And that's state and local, 10.4, 6.1 of that is federal. So state and local still is more. So, you do the math here and we're up to like 86, 87%, just kind of eyeballing it. And then she highlights net exports of goods and services minus 4.4%, and then fixed investment plus 18.8. So her point is, if we've got to import a lot of this stuff, it's exports minus imports, you get the negative number there. Although I think our becoming an oil exporting country, and certainly natural gas has helped buoy that as well. I don't know if I have anything really else to say about that, except I think it's an interesting take. And maybe when, Elon does his Terafab plant, Intel expands, we got Taiwan Semiconductor, the massive plant in Arizona, like that's coming. But to her point, like right now we're importing a lot of stuff. So I don't really have too much on this. It's just, And by the way, we used to import a ton of energy. We're now a net exporter many months.
Yeah, I mean it's good to be aware too, because I think when you hear a number like GDP, right, you just hear the whole figure, and I think it's just important to remember that you got to go dissect it. You got to look at the different layers here, and it's an interesting explanation that makes sense. Don't forget the Micron factory. I think they're doing that out in Boise, right? Mm-hmm. So you've got I think Kramer was on site last week on CNBC there.
Oh, did he go out there?
I think so. Yeah, and the CEO talked, but yeah, I mean, it makes sense. So,
all right, S&P 500 sectors, percent with 4-week highs, percent with 52-week highs. So yeah, I mean, you look at this, healthcare, materials over the last 4 weeks, definitely catching a bid. And healthcare is kind of the strongest blended. Energy, communication services, nobody's percent with zero at 52-week highs. Consumer discretionary, zero at 52-week highs. Financials a little bit weak. So yeah, it's like energy, healthcare, and a little bit of materials. But over the last 4 weeks, all right, nothing really else there. I'm just bringing that up. It's not all necessarily tech, I guess is what I'm saying there.
Doesn't materials make sense with the build out? Like what we were just saying, all these things being built? Yeah.
I think so. I think it does. And I think some of the rare earth minerals, and I think, I mean,
Was that healthcare pulled after the Benderda announcement? I think it was, yeah. This was pulled on Friday of last week. So that probably helped there.
Yeah. All right. Mismatch between number of home sellers and home buyers has completely flipped since the 2021 period. Source Redfin via Jeff Weiniger and the Daily Shot. Okay. I think I've told everybody who put some work into this. This is a chart that says the number of buyers falls to record low. It's a widening gap. So you imagine there's buyers and there's sellers. And right now you have one line for sellers, one line for buyers. And basically the buyers, they continue to drift lower since 2023. And the sellers are rising. And you've got this gap. Now, when I see something like this, and anybody posts that, I would say, okay, it's either telling me that there's a problem with home prices, or they're telling me that home prices are going to go down, or it's real estate agents who are like, yeah, we're not making any money because there's no homes being sold. So I went and I pulled on the next chart from Bloomberg, the Case-Shiller, what's this? The national, Case-Shiller US National. And home prices, this is what, quarterly? I think this is a quarterly chart. They're at all-time highs, the index, the Case-Shiller index. So, when I look at that, and I think we've mentioned this before, Mike, there is the perception of those who are in the real estate markets who want to see transactions, or buyers who want to see a lot of transactions. So is this a case where either buyers have to pay up more, sellers have to lower their prices, or I don't know. It doesn't matter if they're transacting if you own a home because prices are pretty good.
Yeah, I think this is a market where buyers are probably being patient, knowing, if you bought in the last if you bought like between 2020 and 2023 and you have a mortgage, it's probably at a pretty low rate and your house is appreciated. And, if you're going to be getting a new mortgage, it's going to be at a higher rate. And so probably don't feel a need to move out immediately. And so I think it may be a case of just, patient buyers, and that coupled with how high prices are. I mean, it makes sense. I would expect that at some point, buyers do come back in the market, and this, it looks like in the past, these two lines converge quite a bit whenever they sort of decouple. So I would expect at some point they'll come back, but it's just a matter of when.
Yeah, I mean, when you look, it's like, so if you wanted to buy a house right now, you would say there's a couple things working against you. One, if house prices are high, you need more of a down payment. If you want to do the 20%, avoid that. But then your monthly payment is too high. Charlie Bolello, Mike, kind of your point, he put out something. He said 10 years ago, a 30-year mortgage rate was 3.4%, and median existing home price in the U.S. was $243,000. Today, the 30-year mortgage is 6.7%, and the median existing home price is $434,000. So $200,000 higher median price, and interest rates are 3.3 full percentage points higher. The result, $38,000 increase in down payment, assumes 20% down, and 160% increase in monthly payment from $862 to $2,240. And I like the way he did this. It's all about the monthly payment. So, like, Mike, this is one of those things where, yeah, I mean, people may be anchored to the old rates. I mean, do you think that's the case? Like, they don't want to buy right now because they're like, oh, I'm not paying 6.7%. Or the reality is the home price is irrelevant. And I think, I realize what Charlie did, that it's smart of him to do that. But in the end, like, most people have a mortgage. You're not buying the house for cash. And true, the down payment matters. But it's all the monthly payment. Like $862, imagine we were just talking about rent, $862 to $2,240. That's the increase. Like, Mike, that's the problem.
That's the problem. That's a significant increase. Of course, wages haven't gone up like that. So that's where the issue is. You're right. Of course, it's all based on the value of the home, but the change in rates is really what makes that monthly payment change, not as much the home price. Like if you see rates go from 6.7 to 5.7, that makes a significant difference in the monthly payment. So that's what people are looking at. Whether you're buying the house or renting it, you want to make sure that the monthly payment isn't going to be way out of your comfort zone. And so, I don't even know if I don't want to pay that as much as it's even, I can't pay that. So I think one of two things might have to happen. You might have to see prices come down significantly because buyers aren't able to afford that with this rate, or you got to wait till rates come down, which, like you said, if you look historically, they're not that high.
No, they're really not. That's the crazy thing. I guess, Shane, when I'm doing the math in my head, and I should have done this before the show, like to get that same monthly payment, what would a home price have to, it would have to decline to what, like 160,000 median at a 6.7 versus a 3.4. I think you're talking, it's got to be below 200,000, right?
Yeah, at least. And that's the thing. Like, I don't think we've ever really seen home prices. I know we've seen them pull back, but like, I don't ever see home prices.
2008 for a while. Yeah. Like it was rough for a while.
Yes. And that was also due to like the major bubble at the time had been specifically within the mortgage security space. So like that naturally, I think, saw deflation, but I just don't see it happening. I think they'll come down steadily, maybe slowly, but if sellers don't have to sell, I don't think they're going to freak out selling property right now and letting it go. And if buyers don't want to buy, I think they're going to sit on the sidelines. But, you mentioned people like to pay attention to the perceived demand or supply. And I also wonder, too, if the more the reports come in about sellers are outweighing buyers, does that actually finally encourage people who've been waiting to buy a home maybe for the past few years to start doing it? Because now they're hearing the reports of the lopsidedness. But
the housing market too, how goes the economy goes housing. That's why people say, we have to have rates back at 2%. Fed funds, we got to have Fed, we should go back to 1. Like, be careful what you wish for. That probably means there's some upset in the economy or the markets and the Fed is stepping in. Like, yeah, if you want to see really low home prices, have a bad economy, have a recession, rates will be lower, home prices will be lower because people can't buy a house, much less keep the more, a lot of people might be forced to sell or walk away from a home. So you don't want that. But
think about how many people got loans at 2%, 3%, 4% while rates were so low. Like, I don't think you're going to get a chance to do that again at the same price levels.
Well, yeah, and that goes to the
value of homes will, have to go higher before the rates get back down to a level like that.
Well, don't you think too, Shane, like people are anchored in the price they're willing to take too. Like that always happens. People start out high and they're like, oh, I'm not accepting less than this. And the reality is, if people are using a mortgage, they can't afford that same level of house. They just can't.
Right. And I mean, this is the beauty of like markets in the sense that, you think of stocks, they're usually pretty liquid. You can get a fill whether you're buying or selling very quickly. And you start to think of the liquidity and sort of the auction and pricing that exists within home purchasing and selling. These processes in this market can take a lot slower and a lot more time, I guess you would say, versus other ones.
They've never solved, Mike, I agree, Shane. And like, Mike, they've never solved the problem of if you have a home and you need to buy another one, but you can't afford both. They tried it. Zillow tried it. I think they got in the business and they went away. What's the company, Mike, that's still in there?
It's been a while since we talked about it. I can't remember the name.
Shane, you remember this one. Open Door. Yeah, Mike, like Open Door. So like they're trying to solve this, but unfortunately, I guess Open Door is still doing it. I wonder if somebody should email us if they've actually used Open Door, and like what price did you actually get relative to what you thought you should get. But that's one of the problems too. Like I applaud the efforts to try and solve that, because like I've sold a house, and if you have a house and you need to sell it before, and you're making contingent offers, you're not in a strong position. I mean, cash is a strong position. Somebody who can go in and finance the house second. But if it's like, oh yeah, I'll buy your house once mine sells, and it's like, yeah, great. I'll wait 6 months, 7 months till you sell your house. So, all right, let's talk NVIDIA. NVIDIA is coming out with earnings on Thursday after the market closes. Everyone always says it's the biggest thing ever. Wait till NVIDIA reports. NVIDIA is late. Sometimes it's a letdown simply because, Taiwan Semi reports, Advanced Micro reports, the hyperscalers report, the capex numbers are out, all this stuff. But NVIDIA is reporting. We talked about this morning internally, and about a 57, 58 implied volatility on NVIDIA's. We look at the August 28th options, the expiry, right at the money. You buy the straddle, it's roughly, a little bit under $13. So, that basically says there's two ways to do this. Shane, what's the trader's way? Tell me the straddle thing here.
I'm just going to go look at the cost of the at the money call and at the money put, add up the midpoint. And that's going to tell me the expected range roughly. And then you take that total divided by whatever the stock's trading at the time. And that gives you your percentage range roughly.
All right. What is it? Why don't you tell us what it is?
I'm pulling that up right now. Based on the close.
I will tell you the 1 day, based upon the implied volatility, taking that divided by the rule of 16 of 15.875, which is the square root of 252, the 1 day expected is about 3.62%. What do you have on the straddle rules, though?
I have $12.63 roughly. And then we take that, divide that by the close of 208.48. It's about 6.05% is the range.
All right, 6.05%. And then what I do, I take the square root of 4, because it's the number of days remaining until earnings times my method, 3.62, and I get 7.24 as a one standard deviation sort of plus or minus move there. So I don't know, like Mike, we were saying earlier, the moves haven't been, I don't think we've seen a big 10% plus move on NVIDIA in a while post earnings, right?
Yeah, it's been a while, and I think the market's been pricing it that way too. I'm pretty sure we look at this before every earnings, and I don't think it's been over 7% in quite some time. So the options market sort of gotten this right in terms of the move. The last few earnings, stocks sort of trailed off after reporting. So like you said, on the surface, it should be and seems like it could be an enormous earnings announcement given how big NVIDIA is and how much of the market they impact. But them being later and sort of a lot of that news already having come out, the last few haven't been too exciting.
No. Now, Shane, like we were talking after the SpaceX call, there were some announcements about SpaceX would use NVIDIA chips. Seemed like NVIDIA got a bid after that. To my point, Mike's, like a lot of this stuff, like the comments. But Shane, like Jensen is going to be on his conference call answering the analyst questions. And if he gives really bullish forward guidance, I think the street's going to like that.
Yeah, I think that there are, high expectations as always. And with where the market's sitting right now, if he delivers strong guidance into the end of the year, if the sort of energy situation, the oil stuff doesn't seem to be a major concern and forward guidance looks strong. Yeah, I agree. I think the market needs that. I think semis really need that right now with the recent pullback.
Tom Lee was on. I forget where Tom Lee was. He's everywhere these days. But he made the point, or maybe the guy was asking the question, like, this is really, after NVIDIA, we have a break. We have a break before the next earnings season with the hyperscalers, with the big names. It's kind of the last one to really put out the data. So the market's going to be somewhat in a vacuum, although not really. So yeah, like, I think it's important. I don't know if they're doing the watch parties. Didn't they do that? Was it a year ago or 2 years ago? They were doing a watch party for NVIDIA's earnings. Like, it was a sporting event. Do you guys remember that?
I didn't see that.
I think
CNBC put it on, I think.
I could see that.
Yeah. All right, let's go to recommendations. Shane, what do you got?
I mean, I'm going to go with baseball. I know football's back, but if you're not paying attention, playoff baseball's getting ready to get going here, and I think it's going to be a good run. I think everybody's rooting against LA, partially because of the salary stuff, which, if you don't know anything about that, that's a very interesting story to read into as well. But yeah, playoff baseball's coming. So,
well, not surprising. You're not a Chicago Cubs fan. Mike is, but I don't think
I'm a Cardinals fan. Yeah, we're not, but it's going to be an entertaining run.
You're going to sit this one out, I think. Mike, what do you have this week?
So this movie called Tuner over the weekend. Give it a buy. It's about a guy who fixes pianos. He's a tuner, and he ends up getting involved in a world of crime and sort of how those two intersect. I thought it was pretty good.
I don't know, like, if you're just telling me.
I know it sounds crazy.
Yeah, so he's a piano tuner, and then he gets involved in crime.
He's got a special, his hearing is really good, and so he's able to use that hearing for ways to benefit this mob.
What was this on?
What did we watch it on?
Yeah, I don't know. I'm just looking. Amazon Prime. All right. Well, people can look it up themselves. I actually watched a movie called Crime 101. It was on Amazon Prime. See that, Mike? I'm giving the audience actionable steps here with my recommendation. That's fine. You're going to make them do the work. Crime 101 was Chris Hemsworth, Monica Barbaro, I guess, Halle Berry, and Mark Ruffalo was in it, Nick Nolte. This guy is like a thief, but it's a little bit of cloak and dagger. I don't want to give too much away. I thought it was really good. Like, I'd say it's a buy to a strong buy. It's on my conviction list, and I like it. It's just a movie. It's like 2 hours, probably a little over 2 hours. You watch it, you're done. It's not 5 seasons, 20 shows, and like hours and hours of my time. So I thought it was entertaining. So Crime 101, Tuner from Mike, and then you're supposed to watch baseball. You can pick your team, right? Just watch any baseball.
Exactly.
All right, guys, we did it. We'll see what happens with NVIDIA's earnings this week. Let's see if it actually is inside or outside the expected move. We said anywhere 6.5 to 7.5%, depending upon the method you use, is the expected one standard deviation move. That's Thursday after the bell. So we'll be back next week, see everything we got right, see how many things we got wrong. And all right, see everyone later. Take care.